Our next topic on our outline is candlestick analysis. But before we get into the studying on what each of those candlesticks means, let's first analyze candlesticks. It is easy to combine candlesticks with the technical chart analysis by focusing on the relationship between the open and close prices. Candlesticks show how market forces change during market hours. The components of candlesticks charts are: 1. We have the opening price level, we have the closing price level, we have the high price and the low price, and this they can be found on any chart, be it a weekly, daily, or the intraday data. And I also want you to take note of something. Some charts don't use the color black and white, but instead they use green and red. You should know that green is bullish while red is bearish, or white is bullish while black is bearish. Some trading software allows you to edit and change the candles to your desired color. The price moves above and below the candlestick body are called the shadow, depending on how large the distance is between high and low of a price bar to the body of the candlestick. Now this image is a comparison between a bar chart and the candlestick chart based on the same open, high, low and close data. The first is the bar charting technique, while the second is the candlestick charting technique. Now most candlestick formations identify either a slowdown in a market trend or a trend reversal. That is why traders like working with candlestick charts, because they show trader behavior in a different but simple price action picture, and it is very easy to combine with other trading tools.
Now, I told you that there are some candlestick formations that will form, that it will signal to us price action traders that the trend is about to reverse. If the trend has been going bearish, there are some candlestick formations that will form that will indicate that price is about to go bullish. Or if it was bullish, there are some candlesticks formations that will form that will tell us that it's about to go the opposite direction. Now, the first candlestick we will look at is the hammer and the hanging man. I will use two color of markers here: the green to indicate a bullish candlestick and the red to indicate a bearish candlestick. For the first candlestick formation, we will be looking at the hammer and hanging man. Well, this is how a hammer works. You have a small body and long wicks, and this is usually forms when the market momentum is slowing down. Price will push down, but before the candle closes, it will close with a very small body. Now, if I should use the red marker also, you have a small body and long wicks. The wicks is usually long below, and the wicks above is usually short. That is why we call them hammer. You can see that they indeed look like hammers. Now, if this candlestick should form on a support level, it's telling you that the momentum pushing price down is slowing down. And if this kind of hammer should form on a support level, then you will likely see price push higher. I want you to take note of this hammer. This is the hammer candlestick. Take note, hammers have long wicks below and small bodies and a very small wick. Sometimes they will not even see a wick above, but it doesn't matter. Just know that hammers have small body above and long wicks below, tiny or no wicks, and these are also called shadows. Wicks, shadows, they are all the same. Now the next candlestick we'll be looking at is the bullish and bearish harami pattern. For the bullish and bearish harami pattern, they are formed after, okay, let's say price has been going down for some time, and then it forms a bearish candlestick. Let's say like this is how a candlestick is. You have the wick. Now for a bearish harami pattern to be legit, the next candlestick to form will be small and it will fit within the body of the previous candlestick. Price has been going down, then it gives you a bearish candlestick, but then the next candlestick to form is a small candlestick, a small bullish candlestick. As you are seeing, it's color green. Now the small candlestick fits completely inside the body of the previous candlestick. Now this is a bullish harami pattern. This is the bullish harami pattern, and it indicates that price will push up. If this should form at a support level, you should know that price will most likely push higher, because after this bearish candlestick, the next candlestick to form is a bullish candlestick, and it fits completely inside the body of the previous candlestick. This is how bullish harami is. Bearish harami is the opposite. After price has been going up, and then you have a bullish candlestick, and this is the wick, but then the next candlestick to form is a bearish candlestick, and it fits completely inside the body of the previous candlestick. If this should form at a resistance, it's most likely telling you that price will go back down. Now take note, bullish and bearish harami, the second candlestick fits completely inside the previous candlestick. The next candlestick we will be looking at is the doji candlestick. For dojis, we have 4 types of dojis. This is the spelling of doji. For dojis, we have 4 types of dojis. We have the main doji, which it has a small body, a very small body, and a long wick, which indicate a slowdown of the momentum of the market. That means that the market is trying to decide on the next direction to go. Will it go bullish or will it go bearish? Now, another form of dojis is the gravestone doji, which is like this. It will have the small body will be below, and a small wick, and sometimes you will not even find a wick. This is how the gravestone doji is. And the next doji is the dragonfly doji. The body is above and this long wick is below, and maybe a small wick above. Like I always say, sometimes you will not even see a doji above. The next doji is the long-legged doji, which is the same thing as this also. It's the same thing. The body is in the middle and you have long waves. And these are the four types of dojis we have. Dojis generally tells forex traders that there is low liquidity in the forex market. There is no much volatility. If there is volatility, the candlesticks the body of the candlesticks will be huge like this and not small bodies like this. Now, dojis tells us that there is no momentum in the market. Now, if any of these dojis should form at a uh, a resistance or a support level, at a resistance or a support level, it indicates trend continuation or a reversal. If any of these, let me repeat, if any of these dojis should form at a support or a resistance, it's signaling to you that the currency will reverse or there will be a trend continuation. All you have to do is to be patient to see whether price will continue going up, then you trade with the trend, or price will reverse. Now the next, and let me clean this so that we'll look at the next candlestick. So the next candlestick we'll look at is the engulfing candlestick, the bullish and bearish engulfing. Okay, let's first look at the bullish engulfing. For the bullish engulfing, there. Okay, let's say the trend has been bearish. Okay, trend has been bearish. It made a support level, then it forms a small body, a small candlestick that has a small body, but then the next candlestick to form is a big bullish candlestick, and this is what we call bullish engulfing. It consists of two candlesticks, a big bullish candlestick and a small bearish candlestick. The next candlestick to form, which is this one, completely covers the previous candlestick. It engulfs the previous candlestick. That is why we call it the bullish engulfing. Now this indicates that after a bearish trend, this small candlestick indicates slowdown of the bearish trend, and then this bullish candlestick indicates now that the bulls are beginning to enter the market and will most likely have a bullish trend coming. Now this is the bullish. For bearish engulfing, okay, price has been going up for some time and then it meets a resistance, then a small bullish candlestick forms with a small body and small wicks, but then the next candlestick to form is a bearish candlestick and it totally engulfs the previous candlestick. This means that the bears are beginning to come into the market and they will most likely push the currency downwards. And this kind of candlestick at a resistance tells price action traders that the trend is about to go bearish. The next candlestick we will be looking at is the morning star and the evening star. The morning star is a bullish reversal signal. The evening star is a bearish reversal signal. Okay, as usual, okay, price has been going down. We have a support level. Then the candlesticks to form, we have a bearish candlestick, then the next candlestick is a bullish candlestick. This is how the morning star works. Like in the morning and the sun rises. Now this is why it's called the morning star, because as let's say it's late in the night, the sun goes down, then in the morning it rises. This is why we call it the morning star. Now this is a bullish reversal signal, and if these three types of candles should form, it's telling us that the trend is about to go bullish. Three candlesticks, the smallest candlestick should be in the middle, and then our evening star is the opposite after a bullish trend. We have a resistance, and then we have a bullish candlestick, then let's see a bearish candlestick that forms, and then a strong bearish candlestick. As you can see, this is the opposite of the morning star, and this is how it works. It's late and the sun will fall. This is just an example. This is why we call it the evening star, and you most likely find price pushing downwards after this signal. So this is how it works. But the next candlestick we will look at is the three white soldiers. The three white soldiers. This is a very simple candlestick. It involves three candlesticks, three white soldiers. We have three candlesticks, three strong candlesticks. Now this is the three white soldiers. It involves three candlesticks. If this should form at its support level, you should know that the bulls are in control of the market and they are trying to push price upwards. So there is a 90% chance that the trend will be bullish. For the opposite, which is the three black crows, this it's a bearish reversal signal. It also involves three candlesticks, which is the opposite of the three black crows, and it tells us that the trend is about to go bearish. It tells us that the bears are now trying to push price downwards. The next candlestick we will look at is the shooting star, which is my favorite, and it's very common. It's very easy to spot on the chart. The shooting star involves a long wick and a small body. Small body, long wick. Now if you are looking at this, you discover that the shooting star is almost the same thing with the hammer. It's almost the same thing with the hammer candlestick. This is the hammer, this is the inverted hammer. They are all part of the shooting star family. So this indicates that there is low momentum and the price will push up, and this tells us that the price will go down, that it will go up. So the shooting star tells us that the shooting star tells us that the currency pair involved is about to reverse, depending on where you see it. If you see a shooting star at a resistance, you should know that the price is about to go down, and a shooting star at a support, which is also called a hammer, is telling us that price will most likely go up. The next candlestick we will look at is the spinning top candlestick, which is almost the same thing with the doji. It has long wicks both sides and a small body in the middle. This generally tells us that there is indecision in the market. The market is trying to decide trying to decide where to go. Should it go bullish or should it go bearish? Now, all these candlesticks we've discussed, they are the candlesticks that tells price action traders that the trend is about to reverse, or it tells us that the trend is about to continue on what it was doing, whether bullish or bearish.